Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, and today we are joined with Scott Carson. He's a real estate investor, podcast host, and speaker, helping others build wealth through debt investing. Scott, we appreciate you coming on the show today. If you could, let the listeners know a little bit more about yourself.
Yeah, I'm out of Austin, Texas, but I invest in about 20 different states. Been an active real estate investor since about my first home back in 2001. And fell in love with the note investing side of real estate. But I bought my first note on a non-performing mortgage back in 2007, and then that's what I've been focused on ever since, is buying distressed debt. So we buy residential, we buy commercial loans, and we always like to, instead of rehabbing the property, we like to rehab the borrower in a lot of cases. So excited to be here today and share the what I call the sexy side of real estate, note investing.
Got it. So nobody wakes up and says, I'm going to be a note investor when I grow up. What pivotal moment did you get that happened to you to where you were, I guess, brought on to note investing, and then you started learning the trade?
Yeah, so I started a mortgage company with a buddy of mine here in Austin back in 2004. And the sponsoring broker is a guy by the name of Bob Leonetti. He was actually traveling the country teaching people about creative financing, owner financing, creating paper. But he also taught about the side of distressed debt, because previously, back in the 80s, they had a portfolio of mortgage that were non-performing that they'd sell off. So he taught that kind of niche of the non-performing side. Well, obviously, we know what happened in 2008 to 2010. So I left my part of the mortgage company basically after having like a 4-year apprenticeship, learning how to do creative financing and how to evaluate and create paper. Well, as a mortgage broker, we're basically doing a loan qualification package a lot of times, but when you're buying debt, it's a loan dequalification aspect of things. You're evaluating, the credit worthiness of the borrower and stuff like that. So when everything hit the fan in 2008, instead of me originating loans, I just started calling the same banks and lenders, taking what I had learned from Bob and Jamie and applying it, and started getting lists. We call them tapes in the industry, lists of notes, 100 notes, 200, 500, 1,000 notes on residential properties or commercial properties where the borrowers hadn't paid in 6 months to 6 years, and just started buying this stuff, cherry picking it off.
The owners haven't paid in a range of 6 months to 6 years, and they still have the property?
Yeah, they still really living in the property. Exactly. Yeah.
6 years later.
Well, that's not even the job. We've seen stuff 10 years, 15 years in some cases. You look at New York, New Jersey, it takes 3 years to foreclose there, and then people can drag it out from there too. So yeah, I don't like to buy stuff that old. We usually like to stay in that aspect where it's, 3 years or less where they haven't paid. It's much more likely to get them out of track. But yeah, we see stuff like that all the time. You have to realize a lot of these bigger institutional funds will buy big portfolios, and they'll be on the top 25% for the most part. And they leave a lot of smaller balance stuff or smaller value stuff in other parts of the country just to sit there. We've also seen a lot of funds that were buying like REO portfolios, buying the actual property, didn't understand how the note game is different, and they're just letting stuff sit there and rot, not approaching it in a lot of ways. So yeah, it's always shocking when we see that. I was looking at a deal yesterday, and we saw one that had been paid on in 7 years. Well, it's because an attorney's living in the property, and they know how to delay the foreclosure in a couple of ways. So that's one of the reasons we see, a lot of times too, you'll have like what happened during COVID, where states will stop foreclosures overnight and something like that, where you can't foreclose for 12 to 24 months. That adds to it. Or maybe the lender or the bank loses the actual collateral file loan documents, and they can't foreclose because they're missing the files in a lot of cases. So we'll see that, a variety of different things happen out there that may delay things like that.
That's wild. So okay, let's tell us about your first note tell us the first one.
Very first one. Okay. Very first one was in Detroit, Michigan, and it was actually, I'd gotten a list of 500 notes from Banco Popular, okay, big bank out of Puerto Rico and South Miami, and they had this huge portfolio of Michigan notes that were they were selling for literally like pennies on the dollar, and they had this property I came across. Said, well, let me figure this out, and I was like, what do you want for this one in Detroit? It wasn't a bad-looking house. It was vacant, and it wasn't trashed out. And I was like, well, would you take 500 for it? And they're like, yeah, we'll take 500 for it. So I was like, I paid $500 for this property in Michigan. I was like, I didn't want to own the property. So I turned around and sold it for scrap metal the next day for $1,500, which is kind of funny. You know what I mean? To somebody that was going in and demolishing houses in this block and stuff like that. So that was the first one. But the really one that
You
really
sold it. You sold the deed to the property for $1,500. You bought it for 500. It sold basically the land and everything inside the land for 1,500, made $1,000.
Yep, in 7 days. Exactly. And so, I've had people that have come in, we've, bought hundreds of properties or hundreds of notes in Michigan, not with the idea to own the property, but they're actually turning around and modifying the property for cash flow, modifying the terms of the loan, keeping people in their houses, and it turns into great cash flow. We've done quite a bit of that. But this is the first note I was buying. Like, well, $500, I'll throw $500, away if I'm not able to move it and go from there.
Well, because it's still a house. So if you spend $500, you bought the deed to the house, so you still have a house out there. If you choose to fix it up and rehab it, then but that couldn't have been worth even doing anything too if you sold it for $1,500, right?
Yeah, I never went inside of it. I was just looking to see what I could do with that first note.
But that was proof that this is real. This is real. Yeah. This happened. So
here's the thing: you got to realize we have mortgages created every day that are sold every day. Proof of concept. This happens all the time. If you've ever gotten a mortgage on a property and then got a notice in the mail, a month or 2 months after you finance a property, hey, your mortgage has been sold from ABC Bank to XYZ lender. That happens all the time.
Yeah.
And most of the time when we're buying debt, we're not actually buying the actual the deed. We're actually, what transfers ownership a lot of times is an assignment of mortgage. That's what gets recorded to the county. And to own the property, most of the time, you've actually got to go through the foreclosure process to wipe out that deed, and so that you can actually take the property back. This actually was a contract for deed in Michigan I bought. So basically the ball had already gone away, and we were able to do a cancellation of contract. That's why I owned that actual property without having to go through a foreclosure process in Michigan.
Okay, so you got confidence. It's real. So then it gets you to the next one. Tell us about your second one.
Second one was actually a 75-unit apartment complex in Laredo. Borrower hadn't paid in roughly about 3.5 years, if I remember correctly. We ended up buying the note for 30 cents of value. It was from Wells Fargo Financial. It was the actual lender on the deal. And then we sold that for I think it was a $75,000 wholesale fee to somebody to come in, take over the note, finish the foreclosure up, and then they took the property back.
How long did that take, that entire process?
Took me 45 days. Basically, we got the note approved for sale. We went out and found an end buyer who was interested in taking over ownership of the note deals. Yep, the operator. And so he was fine with us making that wholesale fee because he was still buying it at a substantial discount than buying like the MLS or buying it traditionally. Okay.
So I just see this being a lot harder today. And I say that because there's so much wrapped around in finding the real estate, finding the deals, but it's not. You're telling me it's not.
No. So here's the thing. We all know, a lot of people get in the note space and they're targeting like owner finance notes. So then they're sending out like letter campaigns, direct mail campaigns to people who have owner financed a property. That's what most people think when it comes to note investing. And that's really difficult. Low success rate. You get a lot of tire kickers that don't want to sell their performing on a discount, or they had to owner finance it because they couldn't sell it traditionally. Okay. When you're buying direct, there are literally right now, if you give or take a little bit, about 20,000 lending institutions that are non-bank lending institutions that have paper. They're originating stuff, they're holding stuff. There's also about 5,000 other banks out there that are licensed banks across the country. Now, you're not going to go buy a portfolio from like Wells Fargo, Bank of America, Chase, Citi. They're just way too big. They're not usually going to sell a one-off note in a lot of cases. All right. Sometimes they will commercial, but on the residential side, they're not. But that still leaves a tremendous amount of opportunity. Now, you don't have to go dollar for dollars. It still helps. I used to have to make 50 to 100 phone calls to get into the right departments and chase people down. You still have to follow up. But if you go over to LinkedIn right now and type in special asset manager or secondary marketing manager or whole loan trader, those people that have those profile names on LinkedIn are the people at these lending institutions that are responsible for moving debt. And it's just a matter of contacting them and, hey, what do you have on your books this quarter, this month that you're looking to get rid of?
You said special asset manager?
Special asset manager or secondary marketing manager or whole loan trading. Like a whole loan trader is going to work for like a real estate investment trust or a mortgage fund, is responsible for selling their portfolio off.
Okay. And these people are the gatekeepers in a sense.
No, they're the people holding the paper. They're the people at the bank who are responsible for a lender's portfolio. of either keeping it clean or moving it off. Because for every lender, or especially a bank, if they've got a non-performing note on their portfolio, they've got to increase the reserves that they have to hold back and can't lend out on a regular basis. So one non-performing note stops them from basically flipping that paper every 12 months or every month, so 12 times. And that's why a lot of times they're looking to move it off their books.
So I think the distressed debt investing is the biggest, I guess, fear factor, because you're taking something in distress, you're buying that, and you're not supposed to go out of business.
So here's the thing. What you have to realize when you're buying non-performing paper, you're buying it usually at a substantial discount.
Okay. It's risk adjusted.
It's risk adjusted for sure. And if it's an occupied asset and I'm buying it at 50 cents on the dollar, I've got more flexibility in reaching back out to that homeowner and saying, hey, what happened? I know you're 2 years behind, and the bank, lender probably want you to bring 2 years of payments to the table. You probably can't afford it. Can you bring 3 months? Can you bring 4 months? Can you start paying on time again? And we'll defer a balance or adjust it. All right. If you can't play ball, I hold the keys being the lender anyway. We could do a short sale. We could do cash for keys. Or if they won't play ball, then we do the right to go to foreclosure. And now we take the property back or sell the property off at auction. So it's not the same thing as like, oh, I'm going to buy a note and be in and out of it in 90 days. It's a little longer process because each state has a different foreclosure time frame. Here in Texas, you can foreclose in 30 days. Florida would take a year. Missouri's like 90 days. Ohio's 9 months. So, but the great thing is a lot of times when we buy a note, we're literally seeing beneath the kimono, Josh. We're seeing the servicing notes. If the borrower's been responsive back and forth, we're seeing hardship letters. We do a little social sleuthing to see what they're doing online. If the borrower's filed bankruptcy, like a BK Chapter 13, we'll see what kind of payment plan they've put forth in the bankruptcy hearing, and we can buy that at a discount for cash flow. So it's not as like, throwing darts blindfolded. You know what I mean? You do pick some things and you just structure the things like, we know this deal's going to take 12 months from start to finish. We're going to be into it. If they decide to foreclose, okay, we'll go foreclose. We'll be out in a year. But 70% of the time, if we're buying an occupied asset, we're actually able to keep the borrowers in the property, and the cash flow coming into it, the little extra skin in the game we ask, is going to result in a double-digit return for us usually. And that's what we shoot for. If they can't bring money to the table, then we know we're going to go the foreclosure route, and we're buying it at a big enough price below value and below what they're owed so that if we sell it at auction, we're going to make a great return as well.
Tell us about a horror story that was just terrible. You wish you knew then what you know now.
So I always say don't buy in Chicago. Don't buy debt in Chicago, okay? Chirac, I like to call it. It's Crook County. So we bought a portfolio of 10 hard money loans in there, and we bought them at like 50 cents of the balance. So most of these hard money loans were originally written at like 70% of the after repair value. So we thought we were picking up a pretty good deal. Well, being an out-of-state investor trying to evict people in Chicago is not a fun spot. The judges, when you go in front of eviction court or foreclosure, would completely keep delaying. We had a couple properties that were able to get foreclosed on, and then we would go to evict the tenants. Well, the people would, we'd kick them out because they weren't paying, and they'd break back in. We had like one property where people broke in 4 times and stole all the copper out of it, all right? And that doesn't help, obviously, your rehab costs when you're taking property back like that. We had another one where the guy pulled a gun on the process servers and was like, oh, no, this is my sovereign country, a little bit of crazy. And I'd show up. I'd actually show up to court sometimes and be like, listen, we've been giving this guy an opportunity to get, to make payments again or do this. He's not doing, well, let's give him another 90 days to see if he can afford it. So I'm just like, I hate Chicago. I love Chicago sports team, love the food, but don't recommend buying debt in Chicago unless you live there. We had another one down in Florida where the guy hadn't paid in 4 years near Miami. Great house. Bought it at a substantial discount, and we bought the note 2 months before COVID kicked in. So that delayed it another 2 years before we could foreclose. And this guy, played up, oh, I'm dying of cancer, or I don't speak English.
And you're having to pay for, you've got cash out of pocket during this time, right?
Exactly. So you're paying money, paying money to investors, paying attorney fees, and then finally evicted the guy, and we were able to still made a good chunk of change. And we knew going into the deal that this guy was shady. We'd seen all the other stuff that he'd done, but unfortunately we didn't see COVID coming in, delaying it, 18 to 24 months to make things happen. So the great thing is, those are rarity. I mean, if you buy in New York, you're probably going to take 3 to 4 years, if not longer, to foreclose. So I just don't buy in those cities.
Yeah.
We try to buy in faster foreclosure dates or non-judicial foreclosure states, lender-friendly states. But we do buy in like Ohio, which is judicial, takes 9 months. South Carolina can take 12 months. The thing you got to realize is that we're able 70% of the time usually get the borrower back on track if it's occupied, making payments again within like the first 90 days. And so, we have some that, take a little bit longer, but most of the borrowers literally want to stay in their house if they just have somebody to talk to and you can work with them in a variety of fashions.
So I count units, you count paper, I guess?
Yeah. I mean, you count units, I count files, basically.
Files.
So yeah. But like we're working, you like multifamily. I'm working on a deal right now in Indianapolis. It's 78 doors on a multifamily that the borrower hadn't paid in the last 12 months. They bought it back 3 years ago, rehabbed it, and we know what happened with interest rates. So they haven't paid. Great thing about commercial paper, they haven't paid. So we're able to go in and buy that asset at roughly about 65, 70 cents on the dollar of debt with another 25 to 30% of equity on the positive side. They fully rehab the property. And the thing is that the default rate on the note is like 25%. So which means you don't pay any cash flow, negative cash flow for them. So it gives us the opportunity to come and say, okay, do we want to operate this property, take the property back? We'll do that. And then we own the real estate. I'm out of
Cincinnati. That's about an hour and a half for me. So Indy's a good market.
It is a good market. My first big apartment deal, a big one, I say, was 300 units. And we bought the note from Banco Popular as well. And bought it as
how do you get the phone calls for these, or how do you find these deals? Because is it being out here, getting your name out, banks?
Yeah. So like I said, a lot of it's been reaching out on LinkedIn and just following up with people. Hey, what do you have on your books this quarter? There are different servicing conventions that people go to, and we track those to see who's showing up, and they'll often say that first name, last name, company, and then their job title. Well, if John Smith from Banco Popular, who's in charge of the special assets, is going to an event, that's who I'm going to target. You know what I mean? There's no MLS for notes, so you've got to basically just follow up with people. Yeah,
these are pocket deals. These are 100% pocket deals. Like that Indy deal will never be out on Crexy or LoopNet.
Not necessarily. Okay. Sometimes you will see, yes, LoopNet. LoopNet just merged with 10X a few months ago, right? And 10X used to advertise commercial loans that you could buy the paper on. We were looking at a couple yesterday on LoopNet. Now, like with LoopNet or Crexy, you see something that's going to foreclosure, that's a distressed debt. So we target then contacting the lender on it and say, hey, we see you're foreclosing on this one in 123 Main Street. What else do you have on your books that you're looking to get rid of? Okay. And then they send us lists on a pretty regular basis. Like Capital One used to do a lot of commercial lending back in the before recession days. So I was looking at this strip mall here in Austin, Texas, a small balance commercial loan, and saw that the property gotten sold. When I talked to the agent, he said, well, it didn't really get sold. Is the note got sold. And the new borrower, the new lender on it, was willing to work with the borrower to modify. I was like, oh, who was the lender? And they're like, it's Greenpoint Mortgage, which was Capital One's niche. I was like, oh. So I just started dialing for dollars. It took me a couple of weeks to get into the right department. But once I finally got into the right department, they sent me this PDF, which is 33 pages long PDF with every small balance commercial loan across the country. And half of them were small multifamily. And they're like, I'm like, I can't buy the whole thing. And they're like, no, we don't expect you to buy the whole thing, but buy something, So that led into an 8-unit in San Diego, a 21-unit in Houston, a 27-unit in Dallas, a 75 converted hotel that was a multifamily in Fort Worth. So, and then a lot of smaller one-off notes too that were like small commercial buildings and stuff like that we could buy the debt at a discount. So it becomes a pocket relationship, but that's the thing that I've always liked about notes is once you get in the right spot, most of these lenders are sending you deals every month or every quarter as often as you ask that you can take a look at and cherry pick. So that's I've always liked that. That is huge.
Well, because I'm about basis. The basis is everything, and every property that I've purchased, I'm not gonna say I've been lucky enough to purchase the right price, because luck had nothing to do with it. I knew what I could purchase it for, and I knew what I couldn't purchase it for. In order to put money in for the renovations, in order to get money 2 years down the road when we've restabilized it. So, and it's about time investment too. So, but this comes with that baked in. If you find the deal, you are going to buy it at the right basis because it's already distressed, it's already failing. So you've got to have a risk-adjusted return in order to even take it on. At 75 unit in Indy, like what would that even look like on what would you purchase it for it to make sense, like per door?
Let me pull up. Let me look at the spreadsheet because I just had it up and we submitted the bids on it. So basically, our bid was 2.48 million on the thing, so just
That's
under
awesome.
2.5.
That's incredible.
The loan amount that they owned on it was 3.7. Okay, and they were at their default rate's at 18%. It was 7.25%, but their default rate's at 18% now, and they hadn't paid. I'm sorry, I'm sliding over. So they figured that the as-is value when the loan was taken out was just right at 5 million. All right. And they hadn't paid. Yeah, the last time they made a payment was August of last year. So they're a year behind.
I wonder what the demographic looks like in that area. And
it's a C plus, B minus. You know what I mean? It looked like, based on what we could find, that it had been completely rehabbed, stuff like that. Pretty, not a bad area. I mean, not that, it's not Class A or anything like that.
But it's workforce housing, and I mean, it's Section 8 play and steady Betty income. Okay.
Yeah, exactly. Totally. I think it rents for, they're primarily 1-1s and 2-2s. If I remember correctly, I have to take a look at the mix up on it later. But yeah, if we get that accepted, great. I'm sitting in a phenomenal position. There's another one we got was 36 units in Atlanta, 33 unit in Miami, Florida. It's 100% Section 8. A 22 unit garden style in Fayetteville, North Carolina. 10 units.
How do you have to close on these notes with the bank? Is it all cash transaction?
Usually it's cash transaction. So we're raising capital for private investors. The nice thing, though, if you're dealing directly with a bank on commercial notes, a lot of times, sometimes they'll actually carry the financing on a non-performing note. So if you bring 10, 20% down and you've got a team, okay, great. We'll carry the financing on the rest at a decent interest rate for you.
And they underwrite it just like they normally would for a loan, and just give them all the good stuff, all the paper.
Yeah, exactly. Like, hey, what's your team look like? How many of these deals have you done? You know what I mean? It's not too difficult. Okay, can you bring 20%? Because they don't want to necessarily lose the relationship or have that $1 million loan go off. Now, that $1 million loan is not doing well for them, so they'd rather turn it around and keep it as performing. They'll do that if they already know that the borrowers are ready to walk away. I mean, 18% default rate, that's usually a sign that somebody's going to walk for the most part. So
you're raising capital to purchase these things, typically all cash. If not, then you're going to take advantage of the financing. But are you creating a fund? Is it it's not a syndication. It's got to be a fund.
Yeah. We've got a fund, and we also do a lot of one-off individual deals as well too. With private investors as well, separately.
Just a quick raise, and you tell them how much you need, and I've got a couple of those the good old boys. Yeah, that's cool.
I mean, the commercial deals take longer to work out. So I always say, hey, you retire in commercial, you make your bread and butter on the residential stuff that you can buy and insure through in a lot of cases.
Well, so like that 75 unit, it's failing right now because, they probably overpaid for it, but you still need an operator or a damn good property manager to put in place to get that thing turned back around. Or is it just a rebasis?
So they already have on-site property management. So part of the due diligence aspect of this is we're going to have 90 days basically to dive into the numbers, the rent rates. A lot of the residential stuff we'll never walk. We'll send a realtor out to take photos and pull comps. We're good that way. But on the commercial stuff, you really need to get out and walk it. Yeah. And so we'll look at the management and see what's going on with them, what their costs, and we'll look at the numbers as best we can. Sometimes we're buying stuff we're not getting any financials, so we almost have to recreate the financials, cash flow. But this one, it looks like it's pretty good based on what we've seen so far. Like we said, we just submitted a bid on Friday. The tape came to us on Monday, and so we had 5 days to dive in and pull some numbers on this. But based on that number and the existing P&I payment, we're going to see if we just allow them to stay in their property, we adjust the interest rate back down, we'll still be about 11-12% cash and cash return based on just keeping the loan in place. I don't want to do that. The money makes more sense to either operate it or to turn around and sell it as an REO if you can.
Well, and a lot of these properties that are kind of distressed, they just need to be rebased because they were purchased at too high. And I mean, restabilizing a property takes a long time to rehab. And I mean, you're not going to get your rents, your market on the first lease.
No,
it's the
not
second
at all.
lease, the second year, and that's when you start seeing the property really take off. So it's just takes time.
That's part of the due diligence look at. Hey, how many property, how many units are vacant, how many are, rented out, when do the leases expire, what's up with the market rent and stuff like that. There's this 10 unit in Wisconsin, Milwaukee, that we're looking at that was a remodeled school, and the building was turned into 9 3-bedroom, 1-bath apartments, and then 1 2-1, and newly rehabbed online photos and stuff like that. And if rents are at $1,200, I think market rent's actually $1,500. So that's the thing we're looking at too. Okay, does this make sense? And if we find something wrong with the note, value-wise or rent rates, I have the ability to what we call fade my bid. Like, no, we're going to reduce our bid because it's got, it's on a boiler, so it needs a new boiler, something like that. We're going to reduce. Oh, it needs a new roof and stuff like that. Well, the value is not the $5 million, as you said. It's less than that, so we're going to drop our fade our bid down and reduce it. And if they don't agree to that, then we just walk away and go on to the next one.
Yeah. So you would buy the distressed note, and then you still have the actual owner of the note that you have to deal with, right? Okay.
That's correct. Yeah.
So
and we see that and the great thing is we're seeing the servicing notes. We see the conversations, if they were friendly, if they were not friendly, if they answered the phone or hid. So we're able to see all that note from the servicing company, and that's a great thing. It gives you kind of like behind the scenes view of what's going on.
Man, okay, but it still takes that person willing to pay, even though you own the note. They still cash needs to transfer from their bank account to your bank account, right?
Yep, still need them to pay. And if they don't pay, then we'll just dump it with our real estate attorney and start the foreclosure process. Now, a lot of these, the lenders already started the foreclosure process. So we'll just step into the bank's shoes and step into the counsel's position and just finish up the foreclosure process, which will have to restart it all over, which is really nice, especially if it's a state that takes 18 months and they're already 3/4 of the way through foreclosure. You know what I mean? We don't have to wait a year. We're like, okay, it's 90 days. Has the judgment's already been filed against the borrowers? If so, great. We'll just step in and, it's just an assignment of plaintiff, and then we're rocking and rolling to foreclose.
You would definitely need a mentor to get into the industry for sure. You can't just learn your way through it. Like, trailblazing's great, but you need somebody for sure to get it's got the sharp eye.
Yeah, I mean, that's the thing. I mean, I was very fortunate to have a mentor. I mean, the non-performing note space has always been around. Don't get me wrong. You had the 80s with the savings and loans crisis and RTC days. And then you had this kind of secondary market of investors. I call myself a smaller, investor versus a big, huge, like Wall Street fund or something like that. That's popped up over the last 15 years with everything that happened in 2008 to 2010. And that's also why we started doing our podcast, the Note Closer Show. We're coming up on our 1,000th episode, and it's a lot of me teaching. Mostly, 75% of the episodes are about something to do with the note business. We've got a bunch on YouTube. It's also why I had to start teaching classes back in 2010 to tell investors, hey, this is why this is different than the property, and this is why this is a deal, or this is why this is a dud, and go from there.
Well, before we on the show, I was telling you we got to talk about real estate, because this is about real estate. But this, note investing in real estate, you're buying paper, you're not buying the property. But I could see how this could be top of the funnel to get into the real estate at a great basis. Use it as a top of the funnel.
It totally is, because here's the thing: when we get these lists in. Like I got this residential note list and people hadn't paid in about 2 years, 6 months to 2 years. And it's stuff in 20, 30 different states, right? And not only are they opportunities for us to buy the note to refinance, it's also on some of these are pretty low interest rates. So when can't get to a price that makes sense with the bank, we'll actually reach out and do direct mail campaigns to the borrowers with low interest rates for potential subject to deals, to take over, knowing that we know that the lender is willing to try to modify it in some sort of fashion without foreclosing. So we work kind of both ends of the deal. I don't really like owning real estate because I like owning the debt. I want to be the big banks, you know what I mean? But we still take stuff back. We'll still hold it. We'll still do some rehabs on stuff, and either look to keep it for a while or to look to sell it off in a lot of cases. So like one market that a lot of people are running for the hills from is like Southwest Florida. Cape Coral is the worst real estate market in the country. Well, I bought a lot down in Cape Coral, Fort Myers, and that neck of the woods over the last 15 years. If I can go and buy something at 20, 30 cents on the dollar, which I think is what's going to fall at, that gives me plenty of flexibility to throw in a renter in there for a period of time to ride that market back up and then cash out again.
I really like Southwest Florida. Really like it down there. It's Naples, Marco Island area. It's very cool.
I lived on Marco Island for about a year back in 2010 to 2011, And I'd be walking the neighborhoods with all these empty homes from people up in New York and stuff like that during the summer. So yeah, love that area. Definitely.
Yeah. It's very, what did you move away for?
Because I was buying stuff in North Carolina. So back in
Gotcha.
2010, I sold everything I owned here in Austin, Texas, and planned this 30-week trip across the country to hit all the Major League Baseball parks. And I started having lenders and real estate clubs reach out to me from seeing my blogs and videos and stuff that I was posting about buying debt. And they say, hey, could you come speak to our real estate club? I'm like, yeah. And so that happened. I get down to speak at the real estate club there in Naples, and I'm getting lists in from Oceans Bank and U.S. Century Bank and a bunch of local banks there in Naples. So I just would walk into some of these banks, smaller branches, and say, hey, I buy debt. What do you got in your books? Oh, we don't have anything. I said, well, based on your quarterly report you follow the FDIC, you got $50 million in bad paper. I'm like, hang on a second. And then somebody come out and they walk me into a room and it'd just be stacked to the ceiling with all these vanilla folders of bad debt. And like, there you go.
Damn.
take a look at it. You
have to be savvy. I know you have to have a trained eye for sure, and you have to know what you don't know. You really do need to know what you don't know. If not, you're suicide.
Well, it's just like in any other type of niche of real estate. You got to understand the numbers and understand how it's different, and spend time diving into it and looking at deals. I mean, that's the biggest thing. If you try to do this and just be a podcast or YouTube warrior, School of Hard Knocks, okay, you might get lucky and you can wholesale something if you buy it cheap enough, but you really know what the deal holds to make sure it's a really good deal or price. I mean, a lot of people want to get into the distressed multifamily space, and there's been this gap the last year between what banks want to sell their paper at and what buyers need to buy it at to make sense. Well, that gap is getting closer and closer and closer. So it makes it for some more opportunities, but I'm still seeing banks, like there's a lender out of Dallas foreclosed 2 months ago on 3 big 250, 300 unit complexes. They wouldn't take a discount. Their goal is that we're going to foreclose. We know we're going to take it back, but we're doing the foreclosure to wipe all the mechanics liens out and the other things that are behind us. And we're just going to bring on an operator to joint venture with them to operate it for 3 years so the market resettles. Yeah. Okay, that's fine if you want to do that. And you got to be able to do that, but we're starting to see more opportunities coming. Like banks, like, okay, we got to move stuff off our books. Otherwise, we're going to be a whole lot of hurt, worse than we are in a lot of cases. I mean, there's $800 million in multifamily going to foreclosure in Texas alone between San Antonio and Houston this first Tuesday, which is a couple days out, which is kind of crazy.
Interesting. Damn. Huh. That's news. Yeah, what do you see where do you see the market heading?
Down. We do a lot of economic, we track foreclosures. We do a lot of stuff looking at markets. And if you look at the top, 800 markets across the country, it's looking like we're going to see at least, and it'll vary. I mean, this is kind of being a little general, but these 800 different real estate markets are going to see anywhere from a 10% decline down to 30% decline in values over the next 12 to 24 months. It just is what it is. Already starting to see some of that stuff, ahead of time on the commercial side, but that's just values dropping. So that means more foreclosures. It's kind of been a house of cards. We've been talking about this for about 24 months. When you start seeing record defaults and auto debt and credit cards and student loans and all that stuff, it's just a matter of time before you start seeing defaults on the mortgage side. And it was kind of funny when it came out, all the FHA mortgages that weren't being paid, that were being paid by the Biden administration to kind of hold it up, and they're in default. I'm like, that's no surprise. That's usually the biggest default niche of real estate anyway when it comes to mortgages, is that stuff. So people are kind of scared about values. I'm kind of sitting here smiling silently and trying not to giggle because of the opportunities I know that are coming down the pipeline.
Yeah, I'd say there's a rebasis on, well, unless they get the interest rates. The Treasury, or something's got to change.
Yeah, that'll help. That'll help those that are trying to buy stuff now. But it's still, we're seeing people who have 2% interest rates defaulting. You know what I mean?
Well, but they also put a 7% line of credit on their property. So
yeah, exactly.
They totally took away the point of having a low interest rate.
Yep.
There's a lot of that.
What's funny is I joke that we kind of track garage sale listings. Okay. Back in 2010, when everybody was defaulting, they had this rise up in value and bought a bunch of toys. Well, that led to a lot of short sales and people trying to sell their toys back to pay the mortgage. Well, I always joke. I got a buddy that works for the paper here. I'm reaching out to him. Hey, when you start seeing an increase in garage sale postings, that's usually a sign more distressed debt. As people are trying to sell off what they bought, to try to keep their house. It's unfortunate.
Yeah, that's cool, Scott. I definitely appreciate it. If somebody wants to get a hold of you, learn more about note investing, learn about more yourself, possibly invest with you, how can they reach out?
Really easy. Just go to weclosenotes.com. That's our main website. We offer a free 1-day course to help you guys kind of get the ball rolling to see if it's something you like. You can go to noteweekend.com to sign up for that class for free. It doesn't cost anything. No credit card required. It's just a way to help you guys understand if this is something that you want to do or don't want to do. So weclosenotes.com, the best way. And you can book a phone call with me directly.
Cool. Scott, definitely appreciate it. Look forward to following you. Thank you.
Thanks, Josh. Glad to be here. And you guys listening, make sure you go on and hit that subscribe button. Make sure you're listening to the podcast and leave a 5-star review as well. We as podcasters love to hear that from our audience, so do so. Josh is kicking ass and taking names. What is this, like one episode like 150 or something like that for you?
That's a lot, man. I think it's been like 3 years, but
that's awesome.
It's a way to stay relevant, so get out there.
Amen to that, brother. Good stuff. Keep up the good work.
Appreciate it, Scott. Thank you.
Thank you.